It is building credit and keeping yours healthy. Your credit score is a big part of your financial identity. It can be the most critical factor in determining whether you can get a loan and how much it'll cost. Your credit score is a number, the most commonly known as a FICO score, that helps evaluate how much of a risk it is to lend you money. Welcome back to another exciting video. Today's video is about how to build a good credit score. Before we start the video, please like, subscribe, and press the bell icon. It simply shows how responsible or irresponsible you are with your finances. When it's good, it can help you get access to lower rates, enabling you to borrow for short-term emergencies and longer-term, bigger-ticket items. That's why falling behind on your mortgage payments, car loans, or credit card bills is not a wise move. It may damage your future ability to borrow money. So, while you may still be able to get the things you need, like a home mortgage or a car loan, it could cost you even more in the long run. And that's because you'll likely be charged a higher interest rate. Bad credit can affect you in areas of your life you wouldn't expect. Take employers and landlords, for example. They may examine your credit score to see if you'd be a responsible employee or tenant. Some car insurance companies may also see a direct relationship between your credit score and the likelihood of you being in an accident. And in certain states, this even means you're charged more for insurance. So, how do you build a good credit score or protect what you've already made? In general, there are 5 things you should know about how a score is calculated using the information on your credit report, some of which weigh a little more heavily than others. Payment history. First and foremost is your payment history. That goes for all your bills on your credit report, not just your credit cards. This one's a biggie because it makes up a decent portion of your overall score. Creditors want to know that you pay on time, every time, even if it's just the minimum. Consistency goes a long way. So pay your bills when they're due, and never skip payments. How much you owe. The second most important factor is how much you owe. It's a good rule of thumb to keep your total debt lower than your overall credit. The lower, the better. If you get too close to your limit, creditors may think you're biting off more than you can chew, or you are supplementing your income with credit. So, keep this debt-to-credit ratio as low as possible whenever possible. Credit history. Third, creditors want to see that you've managed credit for a long time. Your credit history shows how long you have been using credit, how you've handled that responsibility, and how responsible you've been. Establishing an excellent long history means you're an old pro at borrowing or managing money and will likely repay what you borrow. Credit types. Your score may also be affected by your mix of credit types. A good combination will span different types of credit, from a mortgage to credit cards, to installment loans like car payments, which are repaid over time and can help you improve your overall score. This is because it proves you have experience handling various account types instead of having a lot of accounts in just one area, and when it comes to balances, lower is always better for your score. Recently opened accounts. Lastly, creditors want to know what you've been up to lately. They'll look at recently opened accounts and where you're inquiring about credit. Even if you're relatively new to credit or are considering borrowing, they want to see who gave you credit and when. Also, applying for too much credit can be seen as high risk because it looks like you're desperate for loans. Take department stores, for instance. Doesn't it seem like they always offer you 20% off if you open a credit card? Although it could save you some cash at the register, consider the possible long-term consequences of opening and paying for another account. So, now that you know what makes up your credit score, it's essential to check your credit reports because that's how your credit score is established in the first place. There are 3 national credit reporting bureaus that you should know: Experian, TransUnion, and Equifax, and you're entitled to a free credit report from each of them every year, which you can request from annualcreditreport.com. But you should know that only the reports themselves are accessible, and that there is a fee to get your actual credit score. Also, check your accounts for accuracy and resolve any problems ASAP. You don't want any skeletons in your credit closet. Ultimately, the best thing you can do to keep your credit score healthy is to pay your mortgage, installment loan, and credit card bills on time. Also, be careful not to exceed account limits and make sure none of your accounts are delinquent. Getting an account turned over to a collection agency can hurt your credit score. If you take these steps, you can achieve a healthier credit score. And that's something that money can't buy. Don't forget to like this video, subscribe to our channel for more informative content, and hit the notification bell to stay updated. If you have any questions or suggestions, please leave them in the comments section below. Thank you for watching, and we'll see you in the next video.